Hello everyone. Last time we mentioned that after a fight on the Capitol Hill, the Congress and the Senate finally passed the CARES Act, which is about $2.1 trillion. And we mentioned that it's kind of like a sausage. We don't want to see how the sausage was made. This CARES Act is almost three times bigger than the 2008 financial crisis, $787 billion. It was the new unprecedented act was making the history in the U.S. But at the end of last time, we mentioned that this when we were talking about this is $2 trillion financial aid, it's actually much undervalued because this financial aid is actually worth of $6 trillion at least. I guess many people, when they hear about why this $2 trillion suddenly jump up to $6 trillion, they're going to scratch their head and say, what, why, and how? So is there a magic? Is that a stage magic? Is street magic? Or is it real magic? I happen to learn, really like not only telling stories, but also all kinds of magic. So what we are seeing now is, I call it the financial magic. People on the Wall Street, they all know this, but when they are going out talking to public, their speech is full of jargons. It's really hard to follow. Even for people with English as their native language, it may take someone to translate it from English to English. If you're not in this finance field, it's probably hard to get what they are talking about. So it's worth of some explanations. Let me do that for you. You may remember I mentioned in that $2 trillion bill, there are about $500 billion direct lending to corporate in the U.S. In that $500 billion, about $56 billion are going to be used for passenger airline and cargo airline, and company like Boeing, which are national security related company. The rest of that is about $454 billion will be used for the other corporate, and the magic works for the other company. So let's take a look at the original writing in this CARES Act. It says this: at least $454 billion, as well as any amounts remaining from the direct lending for passenger air, cargo air, and national security related businesses, for loans, loan guarantees, and investments in support of financial reserve lending facilities established to provide liquidity to eligible businesses, states, and municipalities. If you didn't follow that, it's a really long sentence. It doesn't matter because even political, the media said the language is very confusing. So let me explain that for you. When we're talking about providing liquidity, it's actually just giving money, lending money to buy something. In the Chinese culture, we use feng shui. We said shui, or the water, means fortune or money. So when you go to a lot of the Chinese restaurant, you're going to see a big fish tank at the door. There essentially is trying to accumulate money or fortune. In English, we also use money, this flow of money as liquidity to describe all of the capitals or money in the market. When we are saying that the market is lack of liquidity, it's essentially there's no money. If you want to sell your assets, you cannot sell that at a good price. You have to take a pretty big discount. If you want to buy assets, you don't have money to do that. Let's give an example. Just a few days ago, New York Times has a report. It says when the market plummeted, people are worried about corporate bonds from both the fundamental and the technical perspective. From fundamental perspective, people are concerned that the company, since the economy is freezing up, the company's future revenue will be affected, and in turn that will affect their capability to pay off their corporate debt. On the technical side, because people have to, if they're using margin or any leverage, they have to answer the margin call. So they're selling the goods assets to try to get the liquidity or the money to pay for their margin call. As a result, even the best rated company in the corporate bonds are gets hit really hard. So when we're saying corporate bonds, when you have a discount, we call that a haircut. This time the haircut is all the way to the neck, and the yield or the return is going tripled. It's much higher than before. And for those junk bonds, it's even go all the way to the ankle. It's not to the neck. It's a huge haircut all the way to the feet. So at the peak, the yield for the junk bond is about 11%, even higher than the 2008 financial crisis. And company like Ford, they got downgraded. It was considered as the largest falling angel as a junk bond. And what is even worse than junk bond is the leveraged loans. The leveraged loan, our company already at pretty financial distress, and they are still borrowing money. And of course, we also have something packaged up from the junk loans. They are the CLO, or collateralized leveraged obligation. They are very similar to the mortgage-backed securities. You have the different tranches, and out of those toxic assets, you get something magically as AAA. In the past few years, this very low interest rate environment kind of provide the incentive for a huge amount of this leveraged loans and also the collateralized leveraged obligation. The risk is high, but the interest rate is low, so it's so comfortable for those companies to borrow at super cheap money and to distribute dividends. And as a result, they are buying back their shares and they are distributing dividends. They're pushing their stock price even higher, and everyone become a very smart banker. And now, suddenly, summer becomes winter. Many companies, they cannot get away from it. Other than the U.S. companies, there are a lot of state, county, and municipalities. They are also a big borrower in this bond market. For example, Illinois state. The state government has a budget stabilization fund for rainy day like this. There's only $1.2 million in that fund, and the state pension fund has a deficit of actual deficit of $137 billion. So they need this bond market to function. Otherwise, they cannot provide those pension and a lot of their financial system like Medicare, things like that. And now, when the market is down like this, all of the municipal bonds market also are frozen up. So when we're talking about this market crash, and you probably heard a lot of people are talking about buy the dip. Most likely those people are a retail investor, and you cannot push or change the market. For the bond market, this is multiple size of the stock market, and now this is getting a huge discount, but it's not easy to take the discount. Because during this crisis, everyone is lack of liquidity, and therefore is not even easy to get a quote for your financial asset. And this is related to what we said previously about risk value. When we're talking about this risk parity portfolio, they need to leverage up for those relatively lower risk assets such as bond, and they also hope or expect that when the stock price is going down, the bond price will go up, so they can sell high and buy low. What we are seeing right now is when the storm is coming, the equity market and bond market are both getting punched. So for the high leverage, they get the margin call, and for whoever didn't get the margin call, they probably don't have enough money to buy the dip. So we are seeing the river, is having a drought. We are starting to see the bank of the river. As Warren Buffett said, when when the waves is down, we start to see who didn't wear their swimming suit. And now the situation is we're going to see a lot of people not people, corporate and state or counties, they are actually swimming without their swimming suit. It's really, this is a crisis, so there's no time to wear your swimming suit anymore. And that's why we need to open the floodgate and get water into the system so everyone looks okay now. And that's exactly why on the March 22nd, Federal Reserve cannot even wait for the scheduled meeting on the coming Wednesday, and they have to emotionally lower the interest rate to zero right before the Asian market is opened. And then that didn't calm the market. When they found that the market it still gets panic, they start to mention about this no limit and no time limit, no amount limit. Essentially, they are buying all of this government-backed debt to provide liquidity to the market. And those government-backed debt include the treasuries and also all of those mortgage-backed securities. This happened before during 2008. However, this time they're thinking about something even more, which is buying the corporate bond and also municipality bond. This will be the first time in the U.S. history. So the question is, if the market there's no liquidity, then just let it go, right? Why we have to save the market, and why we not the Federal Reserve are not directly buying the stock but buying the bond. To answer that, you have to see who is behind those corporate bonds or the municipal bond. Most of those bond holders, they are the pension, insurance company, mutual fund, hedge fund, and who are providing insurance to those corporate bonds, which those insurance are the credit default swap, and those are the major investment bankers on Wall Street. And all of those financial institutions, they are the big buyers for the U.S. treasuries. And when you are adding them up together, this is almost more than half of the financial system. So even though probably not any one company is too big to fail, but for the whole financial system, the Federal Reserve have to save it. So once you understand why it has to be saved, the next question is how to save it, right? Ridalio from Bridgewater said the U.S. company will probably lose $4 trillion due to this coronavirus crisis. And Wall Street Journal also reported that in 2019, if you add up what has been there and what is newly added, all of the corporate and industrial debt is about $3.76 trillion. So now the size of the problem is about $4 trillion. However, in this CARES Act, there's only $454 billion. How could that be sufficient to save this crisis? And also, Federal Reserve has their own limitation, and they cannot directly go into the field to buy the corporate bond. And is that printing money? Will that lead to a superinflation? What we are seeing now is once you are start to address or try to address one question, that answer itself will lead to some even bigger question. Because most people will not be very familiar with this bond market. It's kind of confusing and it's hard to explain. So we are spending some time on explaining this bond market. What is that? It's kind of like we are explaining this backstage for this huge magic show. And next time we're going to talk about this magic wand from the Federal Reserve and how this magic will turn about $450 billion into a $4 trillion. I'll see you next time.